Hey traders, and welcome back to another episode of Trade Like Assad. Integrating supply and demand zones into your trading approach is one of the most effective ways to achieve consistent profitability. These zones reflect institutional activity, offering stronger confluence and a clearer sense of trade direction. That's why in today's session, I'll be revealing an advanced trading framework that merges smart money concepts with supply and demand principles into one complete model, featuring multiple entry techniques designed to help you secure top-tier trades. And I'm not just going to cover the theory. I'll guide you step by step on how to implement this rule-based strategy directly on your charts using 3 distinct entry setups. All explained in the most straightforward and systematic way possible. So, be sure to watch until the very end. Your support means a lot to us, so don't forget to give this video a like and subscribe to the channel if you're new here. Catch you right after the intro and disclaimer. This trading setup merges supply and demand principles with the traditional fair value gap model, breaker blocks, and mitigation blocks, forming a robust trading framework that could easily serve as your primary setup to achieve consistent profitability. Before we break down the specifics of this strategy, let's take a brief but essential review of supply and demand zones and learn how to accurately identify them. In a bullish market scenario, whenever price breaks a previous high upward, it establishes an unmitigated demand zone connected to that impulse leg. Likewise, in a bearish structure, when price breaks a significant low downward, it generates an unmitigated supply zone. In essence, supply and demand zones are the regions from which price initiates a strong impulsive move that results in a break of structure. To correctly mark these zones, focus on the very start of the impulsive movement responsible for that structural break. This is precisely the point where price forcefully moved away. In a bullish case, the final down close candle, or a cluster of consecutive down close candles, at the origin of that bullish push defines the demand zone. For instance, in this example, the last 2 consecutive down close candles before the expansion phase outline an unmitigated demand zone. In the same way, during a bearish scenario, the final up close candle, or a series of consecutive up close candles, at the start of the bearish expansion move defines the supply zone. Now, you might wonder, why does price actually respond to a demand zone? And what's the psychology driving that reaction? The explanation is straightforward. In a bullish environment, there comes a point when buying pressure simply isn't strong enough to continue pushing price higher. As a result, the market naturally retraces. When price encounters sufficient supply to absorb, it starts filling the remaining unfilled demand from earlier, which initiates a shift that leads to a short-term drop and corrective movement. But here's what makes these zones truly significant. They're not random areas of support. These are locations where institutional money previously entered the market with long positions. Such zones act as decisional regions that form before large institutional orders are fully executed, giving them substantial importance. When price returns to these zones, institutions often re-engage to protect or add to their earlier positions. Another crucial factor is that big institutions seldom place their full positions in one go. They tend to scale in over several stages, especially near zones where earlier entries left visible imprints. This implies that not all of their initial orders were executed during the first impulse. So, when price revisits these areas, they take advantage of the opportunity to complete the remaining positions. The same concept holds true in reverse when it comes to supply zones. Now, let's look at the bigger picture. Everything we've discussed unfolds through 4 essential phases. The base, the expansion, which can be either a rally or a decline, the retracement and mitigation, and finally, the continuation. And here's the part that truly matters. Our primary focus is always on the continuation phase because that's where the highest probability trade entries typically occur. This strategy operates using 2 timeframes. A higher timeframe for analyzing overall market conditions and pinpointing high-quality supply and demand zones, and a lower timeframe for fine-tuning confirmations and identifying precise entry points. The best combinations I suggest are the 1 hour with the 5-minute, or the 4 hour with the 15-minute chart. Of course, you can use other combinations, but the key principle is that your higher timeframe must always be at least 2 levels above your execution timeframe. Also, Keep in mind that supply and demand zones formed on the 4-hour and 1-hour charts tend to be more dependable, and price action is much more likely to respect them. Now, let's dive deeper into this trading setup and see exactly how to execute trades step by step. In a bullish situation, your first objective is to confirm that the market is trending upward and that buyers currently have control. To verify this, look for at least 2 consecutive bullish breaks of structure. Once that's established, shift your attention to the most recent bullish break of structure. From there, trace back to the origin of the bullish impulse, the move responsible for that break. This origin point defines your demand zone. Next, mark the latest unmitigated demand area on your higher time frame and patiently wait for price to revisit that zone. Once price returns and taps into it, switch to your lower time frame, such as the 15-minute or 5-minute chart, and closely watch for reversal signals. This will serve as your initial confirmation before preparing to enter the trade. The confirmation could appear as a market structure shift or a clear change of character. Either way, that's your first layer of validation. Hey traders, you've been asking for it, and it's finally here. The 2-month SMC Trading Mastery course drops this November 1st. This isn't just another course, it's a complete system to master smart money concepts. Manage risk like a pro, and build consistency in your trades. And here's the crazy part. It's only $500, plus 61% off for pre-bookings before November 1st. Oh, and we're giving away 5 $100,000 funded accounts to our students. Don't wait, click the link, secure your spot, and let's make this the turning point in your trading journey. See you inside. This market structure shift indicates that the temporary bearish movement is losing strength and bullish momentum is likely returning. At this point, price is expected to realign with the overall trend of the higher time frame. Once the bullish structure is confirmed and we anticipate price to pull back, the next step is to search for a buying opportunity. At this stage, there are 3 distinct entry methods you can use to open a position, in this case. A long setup. Each approach has its own advantages and drawbacks. The classic fair value gap model, the mitigation block, and the breaker block. These areas often behave like magnets, drawing price back into them before it continues in the primary direction. In the first entry method, once price taps into a higher time frame supply or demand zone and establishes a market structure shift on the lower time frame, we then look for a bullish fair value gap that appears within that shift leg. That's the area where we place our buy position on the lower time frame. For take profit, you can target the nearest liquidity pool visible on the current chart or aim for key levels on the higher time frame if you're planning for a larger move. In the second entry method, after price revisits the higher time frame supply or demand area and forms a mitigation block on the lower time frame, this gives a strong signal to go long. For a bullish mitigation block to develop, price must first establish a swing low, then a swing high, followed by a higher low. After that, a bullish displacement leg should break above the previous swing high, confirming a market structure shift. Here, your mitigation block will be represented by the up-close candle, or a group of consecutive up-close candles, located between the first low and first high. To execute the long trade, you can set a limit order at the highest point of that mitigation block and wait for price to trigger it. Note that this pattern differs from a breaker block, as a breaker requires the formation of a lower low, not a higher low. Moving to the third entry method, we focus on spotting a bullish breaker block within the higher time frame supply or demand zone. For a valid breaker block, price needs to first form a swing low, then a swing high, followed by a lower low. Afterward, an immediate impulsive move in the opposite direction should occur, leading to a market structure shift. In this case, the up-close candle or sequence of up-close candles formed between the first swing low and swing high defines your breaker block area. That's the zone from which you can open your long position. The exact same logic applies to bearish setups, just mirrored in the opposite direction. Now, let's move forward and break down this entire trading setup using a real trade example. Here we have the EUR4 United States dollars hour chart displayed on the screen. As you can see, price is in a strong downtrend, and the bears are clearly dominating since the market has already produced multiple bearish breaks of structure, definitely more than 2. This indicates that our expectation should remain bearish, anticipating price to continue moving lower, meaning our focus will be on identifying short setups. The most recent bearish boss can be seen right here, and at the origin of the move that created it. we can identify an unmitigated supply zone. So, I'm marking these 3 consecutive up-close candles as my supply area. This provides us with a fresh supply zone, precisely the area we want to monitor closely, as it's an ideal region to look for short opportunities once price retraces into it. The next step is to wait patiently for price to tap into this 4-hour unmitigated supply. Now, let's roll the chart forward and see what happens next. As you can see, price pushed higher and perfectly tapped into the 4-hour supply zone. At this stage, all the conditions we were waiting for are confirmed. A strong downtrend with multiple bearish BOS, a clear structural break on the 4-hour chart, and a newly formed unmitigated supply zone that has now been tested by price. Everything aligns perfectly. So, I'm switching to the 15-minute time frame to analyze price action within the higher time frame supply zone and pinpoint an accurate short entry. On the 15-minute chart, you'll notice that after price tapped into the higher time frame supply, it reversed and created a distinct market structure shift. Simultaneously, it formed a breaker block, represented by these 2 down close candles. Take note of the sequence here. Price first established a swing high, then a swing low, followed by a higher high. Immediately afterward, price reversed direction and closed below those down close candles. This behavior validates the breaker block, providing another strong layer of confluence for our short entry. With all confirmations in place, we can expect price to revisit the breaker block zone before continuing downward towards sell-side liquidity. Here's the plan. I'll set my entry at the lowest point of the breaker block, with my stop loss just a few pips above the higher high. For the take profit, I'm targeting the sell-side liquidity beneath this swing low, which gives roughly a 4-to-1 risk-to-reward ratio. Now, let's play the chart forward and observe how the trade unfolds. As shown, the order was triggered. After a brief drawdown, price reversed direction, dropped lower, and eventually reached the take profit, exactly as planned. Now, let's proceed to the next real chart example. Here we have the Bitcoin dollar 4-hour chart displayed on the screen. As you can see, the overall market structure is strongly bullish. Bitcoin is currently in the midst of a clear bull run. Looking closer, you'll notice that price produced a break of structure through this strong bullish momentum candle, breaking and closing above the most recent swing high. This clearly indicates that buyers, the bulls, are in control of the market. With that confirmation, our expectation is for price to continue moving higher, so our attention now shifts fully toward identifying long opportunities. Next, we focus on the origin of this bullish expansion move, the very impulse that initiated the latest structural break. That origin point has developed into a demand zone. Notice that I'm not marking these 2 down close candles here. If you observe carefully, price already pushed below that red candle through the wicks of the following green candles. Since I only consider up to 3 candles when defining supply and demand zones on the 4-hour time frame, I'll simply mark the zone starting from the lowest point of the expansion, which represents its true origin. This gives us a fresh, unmitigated demand zone, exactly the area we want to monitor. It's a prime location to look for long entries if price retraces back into it. Now, let's roll the chart forward and see how the setup unfolds. As you can see, price tapped into the demand zone and showed a clear rejection. At this stage, I'll zoom into the lower time frame, in this case the 15-minute chart, to carefully analyze price action within that 4-hour demand zone and search for early signs of reversal to refine a precise long entry. Here on the 15-minute chart, if you look closely, you'll notice that after tapping into the 4-hour demand zone, price rejected and formed a market structure shift by breaking and closing above this 15-minute swing high. This indicates that bearish pressure is fading, buyers are regaining control, and price is likely to realign with the bullish trend from the higher time frame. Once the bullish market structure shift is confirmed on the 15-minute chart, we can expect price to continue climbing. The next step is to pinpoint an entry trigger for the long setup, whether it's a fair value gap, breaker block, or mitigation block. Looking closely, you can see that price has formed a bullish fair value gap within this market structure shift leg. This area often behaves like a magnet, drawing price back before continuation to the upside. So, in this scenario, I place my buy limit order at the highest point of that 15-minute bullish fair value gap and wait for price to activate it. Now, let's play the chart forward and see how the trade develops. As shown, price retraced lower, tapped into the buy limit order, then reversed direction and moved higher, exactly as anticipated. This perfectly demonstrates how combining higher timeframe demand zones with lower timeframe confirmations can deliver sniper entries with strong precision. That's all for today, traders. Thanks for watching. I hope you gained real value from this video. If you did, make sure to subscribe and turn on notifications so you never miss future updates. Share your thoughts or suggest the next topic you'd like us to cover in the comments below. We'd love to hear from you. Your continued support truly means a lot to us. See you all in the next video.